Hi folks, welcome to our short lecture on bond retirement and where we buy bonds back in the open market from our existing investors. So what makes this a little bit different is that when we retire bonds, we're basically going back to our existing investors and we're prepared to pay them the going market rate for those bonds, just as if we had issued them today at the date of retirement. So not all bonds are bought back at the market rate, but in this case they are. So in other words, if a bond issuer decides that they want to retire the bonds before maturity, they can go back to their investors and they can agree to pay the investors the going rate, which is the open market or the existing market rate at the date of retirement. And we need to use that rate in order to determine how much cash the issuer is going to have to give up in order to retire those bonds. So now let's have a look at an example here where we have COP Corporation on the 1st of July X2 issuing $600,000 5%, so that's your coupon. Your term is 10 years, and COP pays interest on the bond semi-annually every June 30th and December 31st. The issue, or the yield or market at the issue date, is 6%, so we can see we've got a discount bond here. And again, we're using the effective interest rate method to amortize any premium or discount, which means we're going to use the carrying value of the bonds to open the period and multiply it by the market rate for that period in order to calculate the amount of premium or discount that we're amortizing. So now, if COP decides to retire not all of those $600,000 in bonds, but only $200,000 of the bonds, on July 1st X2, which is 3 years after their issue date. But don't forget, interest was paid on June the 30th, so it's also after the June 30th interest was paid in an open market purchase, meaning that they're going to buy back those bonds on July 1st X5 from their investors based on the going market rate right now for equivalent bonds. Okay, and at that time, the market rate at the date of retirement was 8%. So what they want us to do first is just to calculate at the issue date what the proceeds on the bond issue would have been. So we're not at the retirement yet. So we can use our calculator to do that. So we know from our question the face value of all of our bonds was $600,000. We know the payment every 6 months is going to be $15,000. How do we get that? We're going to take the face value of all the bonds at the issue date, multiply it by the coupon rate, but don't forget the coupon rate is always for a year. Because our bond makes payments semi-annually, we multiply it by a half, so we have a $15,000 payment. Our interest rate at the issue date, the yield is 6%, so we're not using that 8% yet. We're going to use that to calculate the amount of cash that we're going to pay out to the investors to retire the bond. And don't forget, we have 20 periods, right? Because the bond here, they told us it's a 10-year bond, and we calculate N based on the number of interest payments we're making, and we're making 2 payments a year. So 10 times 2 is 20. So when we compute PV with our calculator, we're going to get $555,368. So now to make the journal entry at the issue date, we're going to debit our cash for the amount that the investors would give us, which is $555,368. Credit our bonds payable, which is 5% bonds, and we can squeeze out the difference between the cash that we get from our investors and the face value of the bond is going to give us the value of the unamortized discount. Okay, so now when we retire the bonds, because now they want us to record the entry to retire bonds, but not all of the bonds, just $200,000 at July 1st, 2000 X5, and don't forget we're retiring them based on the open market rate, which is 8%. The first thing we would normally do is we would calculate the amount of any unamortized discount at the retirement date associated with the $200,000 in bonds being retired. And then the next thing we would have to do is we would have to retire the bonds, take them off the books, remove any of that unamortized discount that we calculated in this step here. That's why we're calculating it, because we have to remove it. And then we would also record as part of this entry how much cash we're giving up to retire those bonds and get rid of the unamortized discount on those $200,000 in bonds. So now let's take a little step back here when we look at retirement. You remember that we've always said that we would also have to update the interest any accrued interest in any of the bonds we're retiring up to retirement date. Well, don't forget, in this question, we had already paid that last interest payment. The interest accounts have already been updated. So once we get to July 1st, the June 30th X5 interest has already been recorded and paid. So that's why here when I'm retiring the bonds, I'm not accruing any interest because I got no interest to accrue. The only thing I want to do is retire the bonds. And that means I have to get rid of those bonds payable. So I have to debit the bonds payable account. I have to get rid of any unamortized discount on the bonds I'm retiring. And then I have to record the amount that I'm going to credit cash by. As a result, when I calculate those three things, then I'm going to have a gain or a loss on the bond retirement. And I calculate that by plugging it. So with those facts in mind, let's go ahead and see how we would calculate this. So the first thing I'm going to do is calculate my unamortized discount. And we know that the unamortized discount at any points in time on a bond is going to be equal to the face value of the bonds being retired less the present value of those bonds at the retirement date. So therefore, let's find the present value of not $600,000 but only $200,000 of the bonds, okay, at July 1st. 2000 X5. So now you know that when we calculate the present value at any point in time, we're looking to find the value for N, the number of interest payments that we would have made from the date we're calculating the present value onward, right? That's what we do when we calculate present value. We want the present value of the bond at a certain time, and we calculate N to the maturity date. Right? So the point we're making here is that the number of periods we would have had left to amortize any discount on the bonds would have been the full 20 periods less the 6 periods that we've already amortized. Because don't forget, we're retiring the bonds on July 1st X5. Those 200,000 were part of the 600,000 that were issued on July 1st X2. So we have X2 to X3. That's 1 year, to X4 is another year, and to July X5 is another year. So that's 3 years. But each year has 2 periods because the bond pays interest semi-annually. So we're now going to calculate the present value of those 200,000 in bonds, okay, based on an N equals 14. So now, using the calculator, I'm going to take my future value is 200,000. Now, I'm only looking to calculate the payment that I would have made on those 200,000 in bonds, right? If I would have made a $15,000 payment on 600,000 in bonds, then for a third of that, 200,000, I would have made a third of the payment, which would have been 5,000. So that's how I get a $5,000 PMT in here. And I've done the calculation for you here, right? I've got my N is 14, but don't forget to calculate the present value of those 200,000 in bonds at the date I'm retiring them. I have to use the original yield, right? Because I'm calculating the present value based on the original data. And that's going to give me a present value for the bonds of $188,704 before I retire them. Right? Because this is their value, this is their present value at the retirement date. So now, to calculate that unamortized discount, and again, I have to calculate it so I can take it off the books, that's going to be based on our formula, the face value of the bonds being retired, which is 200,000, less the present value of those bonds at retirement, which we've just calculated, which gives us $11,296. So this is an amount that's going to be included in my journal entry to retire the bonds. So the last thing I want to record here is the amount of cash that I'm going to pay to retire the bonds. So therefore, I can then, once I know that amount, calculate any gain or loss on the retirement of the bond. So now, let's have a look. The cash that I'm going to pay to retire the bond means that I have to calculate the present value of that 200,000 in bonds that I'm retiring at July 1st X5 based on the market rate now, because that's what I'm going to pay them. The present value of those $200,000 in bonds that I'm retiring at the market rate is the cash that I'm going to have to pay to settle that debt. So now I'm going to do the same present value calculation using the same factors I used up here. The only difference difference is going to be now I'm calculating the cash I'm going to need to retire the bonds, but I'm retiring them at the open market rate, which is 8%. So when I compute the present value, I've got $168,311. So therefore, if you think of it logically, I have bonds that are present valued based on my original yield at $188,704. I'm going to pay out $168,311 in cash to settle bonds, settle a debt that I have present valued at $188,704. Makes sense to me that I should have a gain on that retirement, right? And I do. So what am I going to do for the journal entry? Well, I can calculate the gain as a plug, right? $20,393, or just take it as the difference between the present value, which is the cash payment, and the present value of the bonds I'm retired based on the original data. If you don't like to think of it that way, up to you. Just plug it. So how would we do the journal entry? Get rid of the bonds, get rid of the unamortized discount, credit your cash because that's what you're paying to retire these bonds at their book value or their carrying value, and the $20,393 is the amount that you would need to shore it up or to make the debits and the credits balance. All right, and that would be $20,393. But then again, as I say, that's also the difference between your $188,704, if you want to think of it this way, and the amount of cash that you're going to pay out to retire the bonds. Same thing. So this concludes our presentation on bond retirement in the open market.